Joining me for the hour today, right here at Post 9, Josh Brown, Stephanie Link, and Jim Lebenthal. Let's check the markets. We've been in the red for much of the session today, and much of that having to do with the economic data. The JOLTS report today was below expectations. That is good, at least in terms of what the Fed is looking for. It does underscore, though, the softening of the economy, and that was underscored as well by factory orders. So we've got industrials, weaker, materials, energy, some of the more cyclical plays. But, Josh, that brings me to you. And what you have told us is a trade. But nonetheless, you bought Newmont Corp.
Yeah.
Newmont Mining.
Yeah.
Because it is a gold play, correct?
Yeah. Well, I bought it yesterday, and it's a trade based on technicals. But if you've been watching the show for a long time, you know that one of the things that I really look for is when the technicals align with the fundamentals. And I think with the giant gold miners, that's exactly the situation that we're in. Gold has been outperforming the S&P over the last year, up 8% versus minus 5%. If you look at the materials sector broadly, you've got about 68% of them above their 200-day. So you've got kind of a bull market in commodities in general. You've had a pretty nice run in the precious metals, and as my friend Peter Bookvar puts it this morning, gold is now about $30 away from making a 5,000-year high. It's already made a new high in every other currency, in the euro, in the yen. So now making a new high in the U.S. dollar, the dollar getting slammed again today. And one of the interesting things about, like, why will this trade work, or why does gold go up or down? Urian Timmer from Fidelity has this great chart where he shows every factor that people believe is the driving force behind gold ebbs and flows in terms of the correlation. You could say it's inflation, it's deflation, it's this, it's that. None of those correlations are permanent, which is very frustrating. But the last big secular bull market in gold took place 2000, 2001, 2002 in a similar situation economically as the one we find ourselves in today. You saw that again after 2008. You just get these moments where people lose confidence in fiat, in the banking system, et cetera. And for whatever reason, religion or otherwise, they reach for gold. I think the demise of Credit Suisse is like an earthquake. And I think a lot of old money in Europe looked at that and said, what are we doing? Why don't we have more gold? So there are a lot of cross currents happening. If you think about Newmont itself, I love this backdrop. This is the biggest, the highest quality name trading here on the New York Stock Exchange. There's been tremendous consolidation in the gold miners. Newmont has been acquiring gold miners. Yamana just got taken out, split in two. The silver went one way, the gold went the other. So you've got capacity and cost coming out of the industry. And last thing, last year was horrific for gold miners. The cost of mining went way up. We know why. And the commodity price itself went down. This year is the opposite. The commodity price is going up, and the costs are moderating. So I like the setup here. You have a dividend. You have a stock breaking out technically. High-quality company. I'll stay long. We'll see what happens.
Let me ask you, I mean, because you sort of underscored to our production team that, you know, it's just a trade, but you make a case that sounds so compelling that you sound as though it could be more than that.
Yeah, look, there are people that are very good at, like, swing trading or buying things opportunistically. They don't even care what the company does. They're purely looking at RSI and MACD and all of that stuff. That's not what I do. So this is the type of situation where I think the fundamental backdrop can stay good for a while. That being said, if the market tells me I'm wrong, if we get a really big turnaround here in the miners or in the commodity or both, I would have to rethink that and possibly exit. So I'm not married to anything. I'm definitely not married to this.
So, you know, Steph, is it as simple as a flight to safety move that has pushed gold above, as we said this week, over 2,000 for the first time in a year? Is it the Jamie Dimons of the world saying the banking crisis is not over? Quote, the current crisis is his annual shareholder letter. The current crisis is not yet over, and even when it's behind us, there will be repercussions from it for years to come. Obviously, I'm not saying there's a correlation between it. I'm simply suggesting that as long as you have sentiment like Jamie's, there's going to be a move into gold. No?
Yeah, it's definitely defensive. I think it's also a weak dollar play, and it's also a recession play, right? So there's a lot of unknowns right now, and so you can easily see why money would go into gold. I have to tell you, Scott, you know, we've been talking about being data dependent for looking at the economic data points for the last year, right? And that's what we all have been. The data actually, as of late, not so great. Right? I mean, so I've been talking about being a little bit more balanced. Maybe this is my version of being a little bit more defensive in what Josh is doing with gold. I don't really want to get over my skis in terms of cyclicals as much as I was. I am actually buying more defensives. I'm more balanced. We've talked about that.